Welcome back. You're watching The Money Show with me, Kavita Thagliyal. So, changes in currency exchange rates can impact the portfolio of investors in a big way. Fluctuations in currency exchange rates depend on several factors such as inflation, interest rates, geopolitical stability, the balance of trade, among others. Factors like these determine the health of your investments, and thus it is important to understand how these changes may impact your investments and your financial goals, especially if it's aligned with that. So, let's understand all of this. Let's welcome on board Tarun Birani, founder CEO, TBNG Capital Advisors, and take this discussion forward. Tarun, good evening. Welcome to the show. Let's start by analyzing the currency play that you might not know your portfolio might have. So, whether you are diversified internationally or not, how does a currency movement impact your portfolio and the investment instruments that you are into?
Yeah. Good evening, Kavita. And currency definitely plays extremely important role on your portfolio as well as on your financial plan. So let me quickly try to simplify this speed. Right, last 1 year we have seen almost 8% fall in rupee, and we have seen variety of factors like surge in crude oil prices, lot of inflationary concerns, US dollar strength, as well as global economic uncertainties, which are not helping things making it further. But at the same time, we have seen rupee has been one of the best performing currency compared to other emerging market. If we look at now, if I to set this context, I would like to mention that a portfolio has many impacts because portfolio has a lot of dollar defensive as well as dollar aggressive stock. To talk about dollar defensive stocks, we have stocks like IT, pharma, which definitely get benefited due to any fall in rupee. At the same time, there are dollar aggressive stocks which negatively get impacted because of, let's say, higher cost of borrowing and those things. Apart from that, any rise in crude prices affects 80% of the landed cost. Landed cost of crude becomes higher. And just to give you a figure, 80% of the oil is imported in India. A lot of industries like paint, chemical, lot of industries are impacted due to crude prices, and you can see hit on their margins. And that definitely all these companies are part of your portfolio, so it negatively impacts. Again, I have seen these dollar defensive as well as aggressive portfolios are almost 50 to 60% of your portfolio. So it definitely impacts, and what your fund manager is picking up is going to impact your long-term return. Again, one more important part in your financial plan is gold as well as global fund. If I look at gold prices are again negatively correlated with dollars. So any changes in dollar is going to impact gold, and I have seen gold is very large part of Indian investors' portfolio. So that will definitely have a very large impact. If I look at global funds, these global funds from a structure point of view, they collect money in India and they invest overseas. So any fall in rupee impacts the prices. Again, these investments has been done keeping in mind global diversification, which is again a very positive thing. But end of the day, the change in the prices and fluctuation is going to impact the portfolio. One more very important asset class, which is debt, fixed income, is again going to get impacted. RBI moves at the time whenever you see there is a risk of environment building up in the globe, right? What we have seen, the dollar rising, right? At that point of time, normally central banks, RBIs, increase the interest rate at that point of time, and due to increase in the interest rate, you could see your debt portfolio, which is large in duration, which can get negatively impacted. And most of the time, people start building up more short-term and low duration portfolio. So all these definitely impact your financial plan, and one of the most important part of your financial plan and portfolio is assumption of inflation. So any changes in inflation, and since you are importing a lot of inflation whenever the currency depreciates, at that point of time your overall projections got completely tossed, right? And for that, either you will have to take a very high risk or you have to invest much more amount to reach your financial goals.
These points are very important for an investor to understand when it comes to your portfolio construction. But then, going ahead, how can one analyze the rupee's impact on their portfolio? The kind of movement you've explained, inflation and other triggers. Although it's always very good to hire a professional, have a financial planner, or once you've given your money to a fund manager, he takes care of all of this. But then in your current juncture, if I want to understand, one wants to track the impact of currency on their portfolio, how can you do it, especially if it is lined up with your long-term goals?
I think the most important part is you have to make your assumption on inflation. Say 4 years back, your assumption on inflation was much lower when the rupee was much more stable, or at that time when the current or the interest rates were much more stable. At this environment, the inflation assumption has completely changed. So one of the most important point investor need to keep it in mind for their long-term goals, the inflation assumption. And I think one need to give a good amount of margin of safety for this inflation figure, because any change in this can negatively impact your long-term projections. So that is one of the very important part. Second important part is retirement planning. I think a lot of people are doing their retirement planning, and one of the most important assumption there is their investment will generate X amount of return, then they will achieve this kind of return. For fixed income, which are like ETF figures, PPF figures, there you are relatively more confident and predictable returns are there. But investment which are very dynamic, let's say even if you look at debt investment, fixed income, duration investment, there your investment returns will change with the change in currency, change in inflation. At the same time, asset classes like equity again behaves very differently with inflation coming on board. So that will also change your investment returns. So it's very important for investors to be very dynamic about it and make sure that their portfolio is completely aligned to their long-term goals. I'll give you a again very important example. We have seen a lot of kids are going abroad, right, for their education. So their education planning again will their plans will completely
coming
change.
on this. I was actually coming on this because what's happening is people, especially who've lined up their goals where they want to send their kids abroad for higher education, or could be anything, maybe an international trip as well. So, how would you analyze the impact for these goals? Also, now since we're talking about currency play, how can you strategize your portfolio to make the most of this current situation in terms of having an international exposure and that impact? So, two questions.
Right. So first, I'll come to the education planning bit. In terms of education planning, we have seen with the rise in dollar appreciating. That is actually, if you have a India only portfolio, it is negative for you. But if you have a global portfolio, that is extremely beneficial for you. If you have assets in dollars, that is actually going to benefit. And we are seeing the inflation assumption on the education goal. Let's say my kid is 8 years and I'm targeting for his education at age 18. Normally we advise that always consider a 10% or 12% inflation for this, because 4 to 5% would be rupee depreciation, as well as 5% would be on the inflation front due to rise in the education cost. So when you put both of them together and start planning for it, you will make more realistic assumption about the projected amount which you need to work for your kids' education. Otherwise, if you take based on current assumption, current numbers, I think your plans can completely go for toss. Again, one very important item is travel, and we are seeing with the rise of 8-10% in last 1 year currency, you can see foreign travel has become extremely expensive. On top of it, now you have a TDS also, TCS also, right? For any money you spend over going abroad and all, the foreign tour travelers will ask for almost this TCS amount, which again can be adjusted against your normal tax amount, but again it is going to hit your cash flows. So all these are not very positive factors for your travel plan. So my suggestion is you should do things which are in your control. And what we can control is looking at last 15-20 year track record. Rupee has been depreciating at 4 to 5%. So in your education goals for your kids, in your goals of your travel plans, always keep this inflation figures in mind, 8 to 10% rise. Once you keep this in your planning, I think you will work with a very more realistic projections, and you can start allocating your investments accordingly so that you can achieve your investment goal for that point. Yeah.
All right. In the end, now time to rebalance your portfolio, looking at all these triggers, or one should just let it be if you're into it for a long term. You really don't have to rebalance any particular asset class in your portfolio, looking at the currency weakness.
I think rebalancing should not be planned based on any currency movement. I think it is more of a strategic asset allocation plan for your portfolio, and again, it depends on many factors, right? But what is, according to me, is a good exercise is if based on your basic risk tolerance level as well as your risk profiling, you have identified that your equity portion should be X, let's say 70%, and your debt portion should be 30%. Now, with the change of definitely a change in currency will have impact a lot on the asset classes movement, debt, equity, and all. And you will see the prices of all these asset classes will change because of that. If you see your 70-30 equity is moving to say 60-40, you need to add more 10% to rebalance your portfolio because equity is becoming more attractive and your portfolio wants more equity allocation. At the same time, if it becomes 80% equity, at that point of time, you need to sell some equity to rebalance it back.
Sure. I think that will be all. Thank you so much, Tarun, for being on the show and helping our viewers, helping them understand what's the impact of currency movement on their portfolio and investments. On that note, let's take a quick break. Post that, we'll be joined by Gautam Kalia, who will be answering your portfolio queries.